older ages, guaranteed income, looking for a short deferral period, I think that's really the only place that this particular product is going to fit. Hello and welcome back to the channel. It's Matthew Decker along with my associate Brady Watkins. We are continuing in our series today on annuity reviews. We've gotten a lot of requests to go through some of the better annuity products on the marketplace. If you remember from last time, we kind of laid out a big product grid that we update essentially every quarter. So every quarter we go through all the best annuity products for all different kinds of scenarios. And so we've picked one of those products on that grid. We're going to highlight it for you today. And Brady's going to kind of lead us through the high points of the product, where it's a fit, and why you may want to consider it. And I'll also just say on the front end, if you're currently considering an annuity product, or if you already have an annuity product and either you're not happy with it, you're not sure how it works, or it's something you're currently considering and you're unsure whether or not it's going to fit into your holistic plan, you should absolutely reach out to us for a discovery call. This is our wheelhouse. We are experts in this space and we would love to help you make a great decision with your money. So that being said, Brady, what product are we talking about today?
Well, we are introducing the American Equity Income Shield 10. And so this will fall under the guaranteed kind of portion of the sheet that you were referring to. So it's going to be guaranteed income. That's kind of the process that this one is going to follow. The product that's really going to try to aim at is guaranteed income.
So we're talking guaranteed income today, and you said the Income Shield 10 from American Equity.
Yes.
Perfect. So if we throw up the product grid here that we looked at last time, you'll see that this particular product is in the guaranteed income section under a shorter deferral period. So that's what we're talking about today. If you want guaranteed income and you're deferring that income, what is it? Less than 5 years or so?
Yep.
Less than 5 years, this is going to be one of the better products in this space. If this is the first time that you're seeing one of our annuity product reviews, I would encourage you to go see our Annuities Explained video. We'll put it in the description below and maybe add a call out card as well. That lays the groundwork for this discussion and it shows you the different areas on the grid and what they all mean. And it would be helpful for you if this is your first time seeing an annuity review. So having said all that, Brady, where would you like to start with this American Equity Income Shield 10?
Well, I think we have to start with the carrier itself. So we're going to talk a little bit about company ratings, really how long they've been in the space. So American Equity, A-rated in Standard & Poor's, Moody's. They're A-rated, great company to work with, financially stable. They've been doing business a long time. And so a while back, they were one of the biggest in the industry. And so in terms of who you want to go with, American Equity definitely can be one to consider because they're A-rated really with us. A-rated means we would be open to working with them at the very least to kind of check that box. So that's kind of introducing them as a carrier. If you have anything else to say.
Yeah, I'd love to tell a story about American Equity. American Equity has been around for a long time, just like Brady said. In fact, if you've ever been to a dinner seminar where someone gets up in front, they buy you a steak dinner, and they're talking about annuities, chances are you've seen, I'll put it on my iPad here, you've seen this graph. American Equity has one of the more iconic marketing pieces that's available, and it's called the Real Benefits of Indexed Annuities. And I've been doing this a long time. This used to be, this graph right here, we got the red line and the green line. This used to be like the number one sales piece for dinner seminar focused insurance agents. And what they would do is they would get up in front of the group and they would throw up this graph, and you can see that it's got this red line on here, up, down, up, down, up, down. It looks really volatile. Okay, so they got the red line on there, and then they've also got this green line on here. And what they would do, I guess I should explain it first. The red line is the S&P. So the red line is the performance of the S&P going back from 1998 to 2016 if you had deposited $100,000. The green line is the performance of this American Equity annuity. And so guys would get up in front of this group of people that they all just paid for a steak dinner for, maybe 40, 50 people in the room, and they would say, hey, listen, I am here to talk to you about the green line. I don't deal with the red line. Look at all these losses. I don't deal with the red line. I just deal with the green line. So if you want to buy the green line, you're in the right place. And that's what they would do. And what's funny about this particular chart is this product is no longer available, and yet people still use it. In fact, if I zoom in here, I think you can see here, this graph is based on actual credit rates for the period shown on the Index 5 product, which is no longer available for sale. So that's the first thing. If you go to a dinner seminar, you've probably seen this graph. If you've seen this graph, this product's no longer available. And not only that, this product is a guaranteed income product. And we'll probably get into this in a little bit, but these values that you see here, this green line going up, never going down, that's how an indexed annuity works. That's called annual reset. But these values don't matter. And we'll probably get into that in a little bit. So I'll save that for now. I'll just tell you those values don't matter. We'll talk about that in a little bit. But American Equity as a carrier, great carrier. If you want guaranteed income and a short deferral period, they're A+. They're great.
So the next thing I want to talk about is the surrender schedule. Similar to the last video, we have a lot of different categories that we want to touch on and make sure the annuity, or at least answer kind of what the annuity does. So the first one would be surrender schedule in terms of when you can actually get your money out, and in terms of how long you have to wait to get the full amount out. In terms of like the guaranteed amount, it would be 10 years. So a 10-year product is essentially what that's saying. You can see the 10 on the product name. That essentially is saying the same thing, 10-year surrender schedule. So that's the first thing.
And it looks like the surrender charge starts at 9.1%, then down to 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. So those would be corresponding to the years in which you would surrender. So it starts at a 9.1% surrender charge, and then it works its way all the way down to a 0% charge. I would say that's relatively standard. Yep. Nothing special there. 10-year surrender charge, pretty standard.
Yep. So we'll go ahead and get all the boring stuff out of the way here. Surrender schedule, free withdrawals. If you need free withdrawals, obviously they're available on almost every annuity product, but you're probably not getting this to take free withdrawals out or counting on it. And so, especially with this product, you're not trying to do that. But if you need to, it's a 10% free withdrawal starting after the first year. So anytime after the first year, you can get 10% of your dollars out. Of course, that would affect things down the road. It would obviously affect kind of the guaranteed income stream that you'd be able to get later on, but that is the free withdrawal amount.
And that is based on the contract value that year. That free withdrawal is not going to be based on the dollars you put in up front. So annuity products kind of split two ways. Some of them will give you a 10% free withdrawal based on the current value. Others will give you a 10% free withdrawal based on the money that you initially put in. So this one would be based on the value of the contract, not based on how much you put in. It's just important to understand how that works. And again, those two options are pretty standard. One's not necessarily better than the other, but those are the two ways that most companies would do that. So pretty standard so far.
So I want to get into the indexes on this particular fixed index annuity. And as we're going through and looking at them, really the thing that stands out to me, and especially if you are used to seeing IULs, you can see here that it's pretty obvious that these are horrible participation rates and caps if you are comparing to maybe an IUL. There's a huge reason for that. This product is not trying to perform at a high level. They are giving you a guaranteed income. And so your contract value is going to grow based on the performance of these indexes. And that's actually not what your guaranteed income stream is going to be based on. And so really the indexes don't matter. Am I saying that right? The indexes don't really matter as much in this type of vehicle.
You're being pretty confusing. Let's try to maybe be less confusing. But I don't know if there is a way to be less confusing, because this is a confusing product. So you're saying that there's all these index options. This is more index options than most annuities have.
Right.
And you're saying that they're all not very good.
They're all not very good.
Interesting. So we've got an annuity product here that has a bunch of investment options, and none of them are good. And you're saying that doesn't matter.
Yes. So we have to back up a little bit. And we have to ask ourselves, who would be getting this product?
Okay, who would be getting this product?
Who would be getting this product is the question. The answer is someone who is wanting, you guessed it, guaranteed income, a guaranteed income stream for life.
Okay, and so why would the guaranteed income stream not match up with all these index options that you say are bad?
So we're looking at an illustration here, and the illustration is going to show you, before you even purchase the product, what amount of income you're going to get if you follow all the rules of the product. Essentially, wait as long as you need to, take out the year you start. And so you know what income you're going to get, barring any unforeseen circumstances.
Regardless of how these underlying accounts perform.
Correct.
So these accounts are not very good, and I'll just highlight one. We've got an S&P annual point-to-point cap at 1.75%. Pretty darn low.
Yep.
Not much growth
For
there
the year.
for the year.
Yeah.
1.75% growth on the year. And you're saying that doesn't matter. And I'm a little bit skeptical. I don't quite believe you. You say it doesn't matter. And I say, how could it not matter? We've got all these beautiful index allocations. We got the Bank of America, the BlackRock, the CS Tech, the SG Global, the S&P. And you're saying none of that matters. But you're right. It doesn't matter. And the reason it doesn't matter is because this product is all based on what's called a roll-up. Is that right?
Correct.
It's all based on a roll-up. So Brady, would you like to take a crack at describing to the great people what a roll-up is?
I will try my best, Matt, on tackling this first. So American Equity is going to give you a few different options of essentially how much you are getting in return for different benefits. So a roll-up is essentially an amount of interest that your annuity product is going to give you every single year that's going to be guaranteed. And it's typically either going to be compound or simple interest.
And this is not the account value. This would be some kind of income value. So the annuity is going to guarantee that your income value is going to grow at some stated amount per year, which is why the underlying allocations that you may choose don't matter. Because in this case, we got an illustration here. So we got $100,000 initial premium on this particular Income Shield 10. And we see here this IAV interest rate of 7%. So I'm guessing, well, it says right there, rate at which your income account value will grow each year you delay income. So if we have a 7% guaranteed increase every single year on our income account, and the most popular index on these products being the S&P annual point-to-point with a cap of
1.75.
1.75%. It's actually impossible to use the most popular account on indexed products, the S&P, and outperform the guaranteed increase on your income value. Is that what you're getting at? That's why the accounts don't matter, because you actually can't outperform your guaranteed income roll-up on a year-by-year basis if you're going to use the most popular account on these particular products.
Right. And every annuity product is telling a story. And so what this is saying is the indexes are not the main part of the story. You're not counting on the performance of the market. You are looking at the options they're giving you as a guaranteed portion of the product. So that's the story it's telling. It's a guaranteed product. I'm going to hammer that home probably more times in this video, but yes.
So it's a guaranteed income product. We're guaranteed that our income value is going to grow by 7% per year as long as we're in deferral. It looks like we can defer for a maximum of 15 years. And then once we do turn on our income, they're going to take our income value that's been growing by that guaranteed 7% per year, and they're going to give us a guaranteed payout rate. And it looks like on this particular illustration, since we've turned it on, it looks like at age 65 there, and we've chosen a single life benefit, they're going to pay out 6.6% of our income value that has grown at a guaranteed 7% rate every single year we've deferred the income. So it grows to some number. And then once we decide to turn the income on, they take that number and they're going to pay us 6.6% guaranteed for life as long as we're living. Is that how it works?
Yeah, these are concrete numbers. Yep.
So I know exactly what this is going to give me no matter what happens.
Yes.
And that's why it's on the guaranteed income product ledger on our annuity grid.
And now you don't have just one option. So if we're looking at that 7%, that is really where the options are going to be. So there are essentially 5 different options. And I'll get into this a little bit later on, kind of early access type categories. But essentially, you can use a compound interest or a simple interest, and it would essentially depend on how long you want to defer your income on what makes sense. So the simple interest would be a higher rate. I think for this, it's 8.25% simple interest, compound is 7. And so essentially, if you wanted to wait a shorter amount of time, 1 through 4 years, perhaps, like it's in the grid, then that would be maybe a good option to use.
Let me try to distill this down as easily as I can. There's two values on this annuity. There's your accumulation value, which is going to be tied to those poor index choices that we talked about earlier. Low caps, not very much growth there. That's the amount of money that you could walk away with if you wanted to cancel the contract. That's the amount of money that's going to dictate your 10% free withdrawal. But that is not the account that's going to determine your income. Your income is going to be determined by a second value, which is going to be your income value. Your income value is growing at a guaranteed rate every single year that you defer income. And then your income value also has a guaranteed payout rate when you decide to flip the income on. That income value cannot be taken and moved somewhere else. It cannot be surrendered. You don't have access to your income value. You only have access to your income value through turning on the guaranteed income. And that does not come in a lump sum. It comes in payments based on the payout rate. So two values on this annuity. And that's why we talked about at the beginning when I showed you that green line versus the red line. The green line doesn't matter because no one's using this type of product for an account value. They're using it for a guaranteed income value. So Brady, I know that there's several different ways to get your income on this product, and they all come with different fees. I'm going to put up the illustration here, and let's just go through those different options here one at a time. So it looks like the top one that I'm seeing here is a no-fee LIBR. Talk to us about this no-fee option.
Yep. So LIBR, Lifetime Income Benefit Rider. So the no-fee LIBR is essentially the least roll-up that you can get.
It looks like it's 4% compound interest.
Yeah. So if you don't want to pay a fee, you can get 4% with no fee as a compound interest every year. So this is going to make your income guaranteed, of course, like the others. So that's a no fee.
Which doesn't seem to make much sense because why would you choose the lowest roll-up rate knowing that the product, who cares about the fee? If you're not going to have any growth on the product because the accounts are bad, why do you care about no fee for a lower roll-up, right? So this no fee option may sound great, but if you're purchasing this product for guaranteed income, you almost have to pay the fees. Otherwise, your guaranteed income is garbage.
And that's kind of goes into most of these life insurance / annuity products is if you are wanting guarantees, you're going to pay extra fees for that.
Perfect.
Because risk is free. Guarantees are not.
That's right. Let's talk about this next option, LIBR option number 1.
So this is essentially, so I'm going to highlight again, the fees are already baked into the cake of what you're getting in income. And so essentially to us, it doesn't matter as much. The fees, now we're really seeing, do we want to elect simple interest or compound interest? You can see the difference there. The first LIBR is giving you 8.25 simple interest. The second is giving you 7% compound. So the same fee applies, 1.1% annual fee based on your IAV. And so the same fee, it is giving you different roll-ups. One is simple and one is compound.
And this is an easy choice to make. You just basically run the numbers. Which one's going to give you more income based on when you want to take it? That's the one that you would choose. Right. Talk to us about this LIBR with well-being benefit.
So this is essentially the well-being benefit is if you can't do 2 of the 6 daily living activities, you are able to access more money essentially early on, starting after a 2-year waiting period in this product. So the well-being benefit, it's triggered essentially the same way maybe a chronic illness rider on an IUL, or essentially triggered the same way a long-term care policy could. Is unable to do 2 of the 6 daily living activities. You can see it has the same roll-up options, simple interest, compound interest. It's a higher fee. So it's 1.2% in annual fee. And so really what this does is this will give you the option, if a qualifying event happened, this will give the option to essentially double your income. And you can see that there, 200% enhancement income payment. So
for the single life option, it looks like 150% for the joint life option. So when I look at this, knowing that the income is guaranteed in all scenarios, knowing that the fee is not going to change my income guarantee, it's simply going to impact my account value, which I know is not going to be great no matter what because the account value options are trash. I'm choosing to pay the highest fee possible with the richest benefit on this particular product, which, depending on when you want to take your income, is either going to be the simple. If you're taking income like right away, you would choose the simple interest because you're getting 8.25. And if you only have 1 year, doesn't matter if it's simple or compounding, you want the higher rate. If you're deferring for a longer period of time, then you want the compounded rate. And it's as simple as that. That's going to give me the highest likelihood to win the game against the insurance company. All right, so let's talk about the catch, or maybe the fine print on that well-being rider, Brady, because it doesn't just apply all the time forever.
Right. So this runs out. You cannot use the well-being rider money, essentially the doubler, if your contract value runs out, which is the minimum, the guaranteed portion of your product.
So I'm looking at the guaranteed ledger here on this illustration, and it looks like if we don't get any crediting, our contract value runs out in year 16, age 70. This is a 55-year-old person putting in $100,000. This is the 7% compound with the rider. So if I don't have a long-term care event, 2 of the 6 activities of daily living trigger, if I don't have that before I'm 71 performing at the guarantee, then I can't use it, essentially. Is that what you're saying?
Yeah, you can see here we're actually illustrating taking out $14,000 in income. And let's say, we had a qualifying event in the 16th year in that blue section. We get the doubler, $28,000 instead of 14, but guess what? Your contract value ends. And so does the doubler.
And so it goes back to half of where it started. Is that how it works?
Goes back to the floor. You will always be guaranteed that $14,000. So essentially what this is saying is this might not be the best option, the well-being rider, for younger individuals. It might be a good option for older, maybe 70 plus, because you need to essentially use it in the shorter time frame for it to be worth it.
Yep. And we're looking at the non-guaranteed basis here. And this kind of goes to what we were talking about on the front end. The account value performance on this product is really poor. It just is. You're not buying this for account value performance. And so you can look at these rates. So this is, what is this? The last probably 10 years, I'm guessing. It doesn't matter what it is, only because you can see the highest credit on this whole ledger looks to be 4.6%. So if the highest credit is 4.6% and we are paying a yearly 1% plus fee, we're not going to get much bang for the buck out of the contract value no matter when we try to turn on that wellness rider. There's just not going to be many years of that wellness rider available. Even on this non-guaranteed schedule, you can see that we start our income in the same year, 14,282, and we get 1 more year of income doubling before our contract value turns into 0 and our income gets cut back in half. So that well-being rider is good. Don't hear what we're not saying. It's a great rider. You'd rather have it than not have it. But if you don't have some type of qualifying event early on in the contract value, those fees are going to eat that contract value away. And you're probably, if you wait until 80, it's probably not going to be there. Right. So this is a young, I say wait till 80, but we're looking at a 55-year-old. So if you wait more than probably 15 years, you're not going to get that rider for very long before your income gets cut back in half. So that's just a little bit of color on that wellness rider or the well-being rider, whatever they're calling it these days. It's great to have, but you're probably not going to get much out of it.
Yep. So the next thing I want to talk about is inflation protection. And so a lot of these annuity products will essentially, once you start taking income, one way or another will keep pace with inflation. However, that is one downside to this product. It does not have inflation protection. So for example, here on the illustration, you're getting about $14,000 in income. That is not going to go up. It is guaranteed. So you have a guaranteed portion, but it is not going to pace with inflation. So no inflation protection.
The only way it's going up is if you use the doubler. Yep. The doubler is going to exhaust your account value in a year or 2, maybe 3, if you just get phenomenal account value performance, which is unlikely on this product. And then your income gets cut back in half. And so I totally agree with you. And it makes sense, right? This is a product that's going to give you guaranteed income, and you know exactly what that income is going to be on the front end based on when you elect to turn the income on. And that's expensive. If they were to also bake in inflation protection, it would become so expensive that it just wouldn't work. So anytime we see these types of the guaranteed income products, it would be very rare for a guaranteed income product to have some type of inflation protection on it. It's just the way that these products have to work because there's not enough fees to do both guarantee your income and guarantee an increase in your income. What's next?
The next is the death benefit. We have to talk about what happens if you do pass away and there's still value there. So the death benefit is the contract value, not the guaranteed income passed on to maybe your beneficiary. So contract value, or essentially the minimum guaranteed rate that they're giving you. You can see that here.
Yep. So I'll highlight for us here our contract value, maybe 7 years down the road, is $117,455, and our death benefit $117,455. We do not get the $176 income value as a death benefit in this particular case. Some products will do that. Some products will give you the income value as a death benefit. This one will not.
So one of the bells and whistles that this product has is it has a 10% bonus on your first year's premiums, which is most of the time where all of your premiums come from. So it's going to give you an added 10% bonus on anything. So for this example that we're seeing here, the client's putting in $100,000, you get a 10% bonus right away, puts that up to 110.
Which you can see here on the illustration, $100,000 becomes 110, and our income value also starts at 110 plus the guaranteed 7%.
So that's everything that we had that we wanted to cover in terms of the product. So I'll ask you, Matt, who or maybe what type of person would it make sense to look into this product?
Well, I'm a huge fan of products that do give you the opportunity to have increasing income, only because inflation is difficult to overcome, especially if inflation is anywhere north of 3%. If it's 4.5%, 5%, this type of product, while it is going to give you a guaranteed income, you're going to see your purchasing power eroded pretty quickly. And so I would say this is probably best suited for someone who's going to take income early and maybe is unhealthy, because you can add that wellness rider. And if you have to wait 2 years, so you take income early, able to wait 2 years, if you can't access 2 of the 6 activities of daily living, you'll definitely still have contract value left over because you've done it so early, the fees haven't eroded away that value yet. So that's why I think it fits into the grid, guaranteed income with a short deferral period, probably older ages too. Older ages, guaranteed income, looking for a short deferral period. I think that's really the only place that this particular product is going to fit. So that about wraps it up for this video here. We're going to be doing more of these annuity product reviews. There's a bunch of annuities on this grid, and we'll be hitting all of them over the next several weeks. However, if there's a specific annuity product that you would like for us to review, please put it in the comments below. Send us an email, however you want to get us that information, and we will do our best to add that to the list of products that we review, and we'll let you know when that particular product review goes live. Having said all that, Brady, where should people go if they have specific questions for us, or if they'd like to reach out to us and discuss more of this in a one-on-one setting?
Yeah, if you have any questions or you want to chat with our team, head to our website. We will have a book a meeting tab where you can find a time that makes sense for you to chat with our team. We cover annuities, life insurance, full financial plans, really anything you'd like to cover. We are happy to help. We will not waste your time. I promise you that.
Make sure you like and subscribe to the video. Click the bell so you get notifications on all the new product reviews that'll be coming out in the next few weeks. And until then, take care.